Now, Andrew, you are a relatively new governor at the Bank of England. You started on the 16th of March and immediately into perhaps the worst crisis we've seen in a few hundred years. I mean, how's it been?
Yes, well, thanks, Chris, and morning. I mean, if they say timing is everything, I didn't really display it, I suppose, in that sense. So it has been really pretty strange. I mean, just to give you a sort of illustration of it, so my first week, as you say, in the sort of middle of March, by arrangement, the bank was already rotating the staff in the building. I think we had about sort of somewhere between just under half the staff here. By my second week, we were down to probably about 100 staff. And, at the moment, the building, I'm actually, as you can see, I'm not at home, by the way, judging by the background, but I'm at the bank, but literally the building is pretty much deserted. So it is strange, but, the bank is functioning very well. Like lots of organizations, I think we've adapted to using the technology extremely effectively. Lots of people I'm learning to chair meetings online, remotely. So we're doing well. But it is, as you say, I mean, the combination of the world we're in and the crisis that we faced, and the fact that it was on, I think it was the third day of my term when the markets team came into the office in the afternoon and said, we need to talk. That's never good. I mean, I can tell you from my experience, it's never good. And as you know, we were facing disorderly markets and had to act very quickly. So yes, it's been an interesting and not the introduction I was expecting.
Yeah. So if the bank is working well, the economy, as you say, isn't working very well now. And I think we were on a call, a journalist call on that Wednesday, where things were going really badly wrong in markets. Just give us an impression of how bad things are at the moment.
Well, if you go back to that, I mean, that was definitely the low point so far, when we could see the volatility and the disorder coming through into the sort of core markets, so into the government bond markets, into the sort of the core exchange rates, and that really was the sort of the low point when we knew that I should say, of course, the other major central banks as well knew we had to act and we had to take action to stop that. And I think the ensuing action that the central banks took over the few days after that, I mean, we had an emergency monetary policy committee meeting, as you know, the next day. We announced in the middle of the afternoon the next day, and we started buying gilts the day after. So that was the Friday of my first week, and have gone on ever since. And I think for the most part, we've seen, a much calmer set of conditions thereafter. I say the most part because I think the one qualification to that I draw. I mean, if you take another of the sort of slightly bizarre experiences of the last few weeks, I got home one evening, and you get home to find that you put the television on, that the West Texas price has gone negative, and you think, how on earth has this happened? And the reason I highlight that is that although you can tell all sorts of what I might call sort of idiosyncratic stories around that, about the fact that it's cash delivery, it's physical delivery, it's all to do with sort of storage capacity in Cushing, Oklahoma. I think you do have this sort of still this what I might call sort of canary in the coal mine sort of thing that you have to watch out for, which is you have to constantly ask yourself the question, don't be sort of deceived and sort of relax too much based on the ability to tell yourself these slightly idiosyncratic stories. So I think the conclusion I draw from that is that although things have calmed down a lot, there is an underlying fragility, as it's in a way it's stating the obvious, but there's an underlying fragility in conditions.
And the bank's assessment last week was that the economy is now operating at a level 30% or so, but below normal, which is easy because we've had these numbers flying around for about a month, not to realise just how bad that is.
Yes, I mean, in a way that, as you say, I mean, these numbers are flying around, and we can see it all around us. So I think the fact of the downturn is obviously in no doubt whatsoever. I mean, as you know, there is massive uncertainty at the moment. So whether it's 30%, more than that, a bit less than that, who knows? Like lots of organisations, we've invested a lot in high frequency data. Interestingly, the bank had actually already done this in the context of its preparations for a hard Brexit exit, actually. So the bank has been come into this reasonably well set up, in my view, on that front. But of course, all of those data give you part of the story, and then you have to try to put the whole thing together. But yeah, I mean, we're in a major downturn, no question about that whatsoever.
And then looking forward, in that call in mid-March, you were saying you were looking at lots of charts which are very V-shaped. And then we had another on-the-record call with you in April where you said that the Monetary Policy Committee of the bank would have to do a full assessment of the amount of scarring, and that a very clear result in the Monetary Policy Report in May. You just had that report. And there you say you went from being quite optimistic to being quite pessimistic, and then reasonably optimistic again, because the assessment was that there was limited scarring, just over 1% of national income. A lot of people have been saying that the bank is sort of too optimistic about this. Optimistic about the recovery, not about where we are. What's your response to that?
Well, first of all, I mean, what we published, as you know, was a scenario, not a forecast. And that's the first time that the bank hasn't published a forecast in what used to be the inflation report, now the monetary policy report since before independence, actually, if you go back in time. And that was deliberate. The uncertainty is too great, in our view, to have put together a forecast. And we used the scenario, in my perspective, was that it's a sort of an organising device to think about the various influences that are operating. Another
scenario, which is what you really think is going on, have you, behind the scenes?
No, what we published was sensitivities off that scenario, and the sensitivities are symmetric, but I mean, we were clear when we said this last week that the risks are on the downside. There's no question around that. And to your point about the second leg of the V, I mean, it's quite interesting that the reaction to it was both the bank's very pessimistic and the bank's very optimistic, and that's logical in one sense, because the pessimistic bit is that just how steep and deep is the downturn. The optimistic bit is what's the path out of it. The reason that we had a different profile in that scenario to what you might call, if there is such a thing, a sort of a normal recession, that's a sort of slightly strange term to use, but nonetheless, is that there are arguments for why this one is different. Obviously, we've had a sort of a closing of the economy. It's not a recession that's been tipped in through a sort of a particularly sort of uniquely economic development. It's had a particular sort of non-economic underlying cause, which has caused the economy to close. So it's reasonable to think that there will be over some period of time, obviously, a reopening of the economy. It's also, in our view, reasonable to think that policies like the job retention scheme, which are there to prevent, in my view, to preserve people's livelihoods and incomes and prevent a bigger rise in unemployment, will be able to enable a restoration of employment more rapidly than you would get, again, in this sort of hypothetical quotes normal route out of a recession. So there are arguments that we went over, we think, to sort of support that view. You rightly raised the question of scarring, and let me say, there's a huge amount of uncertainty around, I think, any assumption on that front. I think there's reason to believe that if the recovery operates in the way I suggested, that we can imagine that a lot of jobs and a lot of activity will come back at the point when the restrictions are lifted and people get confident about going about their daily lives and their jobs. And that, if that does happen in a way that restores activity, then we will get less scarring in the sense that fewer firms will fail. There'll be less unemployment. But I have to be clear. I mean, there are obvious routes to getting scarring. Firms can fail. Firms can fail because they were over-indebted, let's say, before the crisis happened. They could also find that they're operating in markets where we come out of the crisis and people's pattern of demand just changes because we've all gone through a pretty massive experience. So there are all sorts of reasons. There will be, I'm sure, some scarring. I would just reiterate, there's a huge amount of uncertainty around what it will be.
So would you put yourself in the same place as the Treasury, which was reported this week, saying that there's going to be a prolonged recovery and permanent damage to the economy?
Well, I think that is clearly one of the possible scenarios. I do think there are reasons to believe that if we get a route out of what I might call the sort of the medical element of this, and I always say we're not experts in that field, claim to be at all. But if the technology does enable a route out of that, and I think, again, a point I've made once or twice, if we can, in a sense, get through the confidence of effects of any second wave that may or may not happen, then I think there are reasons to believe that the economy and life will come back on stream.
Yeah. So now, of course, the Bank of England doesn't just look at the economy; it also looks at the financial system and particularly the bank. So there is a slight tension here that there's a suspicion that maybe the bank had a more optimistic forecast than it really thinks is likely, because had it had a more pessimistic forecast or realistic forecast, then that might have shown the UK financial system to be rather weaker than it did show last week. What do you say to that?
Well, let me say, first of all, the reason that we, for the first time ever, we published the monetary policy report and the financial stability report together at the same time was precisely for because of the point you make. I mean, in normal times, the monetary policy committee is putting together a forecast which you could sort of describe as the base case, if you like, sort of central projection with risks around it for the economy. And the financial policy committee, financial stability, is operating obviously in one tail of the distribution. The reason that I was so keen that we did the two together last week was obviously the monetary policy committee's view of the world is a view in stress. And if we'd only published a monetary policy report last week and had not published a financial stability report, which would have been the norm actually, I think we would have left the question begging in a way that, in the worst version of it could have led to questions over financial stability, because people would have said, well, you published this view of the economy and stress. To your point, what is the impact of that stress on the core of the financial system and the banking systems, which is why we did the.
You think it's safe, even if it's a worse outcome than predicted?
Well, so what you can, I think, draw from that is that the scenario, the scenario that we used in the monetary policy report, applying that, the outcome for the banks was inside the stress in the stress test we published last year. And there are a few reasons. I mean, a couple of reasons I draw out for that before I go on to the sort of the sensitivities was, one, obviously there's more discretionary fiscal policy being applied in this stress than we normally assume. So the losses going through to the banking system are therefore assumed to be lower. Secondly, typically we motivate the stress test with a combination of a recession and a rise in interest rates, because we found over time that in order to get the bigger stress into the system, you have to sort of make that sort of assumption around the scenario. Now, obviously, we haven't got it in the scenario this time, that the increase in interest rates, because it's not likely. So that's a difference. Now, to your point, you can do the numbering, and we gave some indicators of this, that if you then apply the sensitivities that we had in the monetary policy report, so if you assume longer lockdown, for instance, you can work out where the stress test goes to, and there's still quite a lot of headroom, frankly, to go. But your point's correct, Chris. I mean, obviously there does come a point where if this thing goes on long enough, you'd start to call that into question. Nobody should deny that.
Yeah. Right. You talked about the large amount of fiscal support, government support.
Yeah.
Also a lot of monetary support, which has came from the March decision to essentially print or create £200 billion and pump it into the economy by buying government bonds. Can you just say what you're trying to think you're achieving? What are you doing when you are creating money and buying government bonds?
Well, I think we're doing a number of things, which are all closely related, by the way. So obviously, first of all, as we said, we go back to March, I mean, there was a very clear threat to stability of financial markets, and we had to act very quickly. And I think the announcement of the further purchases had quite a sizable effect in that respect. And by the way, I think there's two parts to that. I mean, it was the scale of the intervention, because 200 billion is the largest that the Bank of England has ever done in one go. But it was also the pace of it. We were very clear that we were operating at pace, and we are. I mean, we're buying, give or take, a month, 50 to 60 billion pounds of assets a month, which is the fastest again the bank has done. And I think you could see, and by the way, obviously other central banks, as I said earlier, came in the same way around the same time. So you've got to look at the sort of cumulative effects of these things. You could see an effect on markets and on the cost of borrowing coming through that way, and that's important. And it is important because, of course, at this point, we know that there is going to be a very substantial increase in the immediate issuance of debt, like of government debt. And we knew that that was going to strain the capacity of the market in the short term. And we knew that we had to play a role both in terms of stabilizing the markets across the board and enabling the the shock through the issuance of government debt to be absorbed. And that was, for me, a very important part of it. Now, all of that then had to be in the context of the inflation target and obviously what goes with that, which is the framework and the independence of the bank. As you can see in the scenario that we put together, the inflation profile has inflation dropping pretty much to zero. And of course, a big point behind that is the oil price. And it then, just about comes back to target on that scenario by the end of the horizon. So we're not looking at a situation where inflation is rising, sharply beyond the target.
And Robert Steeman, the head of the Debt Management Office, gave an interview to the Times about a week ago, where he said, and I think this is exactly what you hear when you talk to people in the government bond market as well, that they feel that your purchases are absolutely vital in keeping that market stable. You've got one really big seller of government bonds, the government, and one really big buyer, a few days in the secondary market, the Bank of England, and then the private sector is sort of holding the same amount of bonds net. This I don't think anyone is suggesting that you are causing difficulties or taking risk with inflation or have lost the independence. But this is essentially monetary finance. We are using central bank money to finance the government, and probably that's necessary. But the bank seems very unwilling to accept that that's actually that everyone in the market thinks that.
Well, I tell you what, I think it's interesting. I think one of the things that's come out of the debates we've had, actually, which of course you've been a big part of, and it's a good debate, is that there isn't really a settled definition of monetary financing. I think that's one of the things I've concluded from this. I think the couple of points I would make. One very clear definition of monetary financing is what tends to be called in the literature fiscal dominance. And there is no fiscal dominance here. Let me be clear about that. Secondly, in a sort of extreme form of monetary financing, it would be very, very hard to do that in a world where we're paying interest on reserves. So this whole idea of sort of inflating away is very hard to imagine in a world where we're paying interest on reserves as we are. So I would caution against those sort of what I might call sort of more sort of extreme and sort of classically extreme notions of monetary financing. That isn't going on at all. Are we using QE as a tool to do a number of things? Obviously, at the heart of it, to meet our objectives in terms of economic activity and inflation target? Yes. Are we using it to stabilize financial markets? Yes. Do we have to reach judgments on what I would call the counterfactual? What if we weren't doing it, and what would be the situation of financial markets? Yes. Does it make sense for us to do this in terms of what I call smoothing the profile of government, overall government borrowing, and the impact that might have on financial markets, on economic activity? Yes. Do we have choices on that front? Yes. Does it give rise, I think, to questions going forwards? And here for me is one of the really big points. When we look forwards and we all hope we're going to get out of this situation, what does this all mean? We've got bigger central bank balance sheets around the world. I think central banks have done all the right things. As you said, it looks like the right thing to do, but what are the long run implications of it? That's what we are going to have to think about very hard. Because, you've now seen two crises, and, we've had a decade, but we've had a crisis at the start of it and a crisis now at the end of it. Both have led to an expansion of central bank balance sheets. I think we are going to have to look at that and say, what is the optimal policy for managing central bank balance sheets? What's the right sort of, if you like, term for this intervention? How should the central bank be managing its balance sheet in that sense? But I have no question in my mind that what we're doing is the right thing to do from the point of view of all our objectives, including, frankly, the economy and being able to smooth a huge shock, for which it was essential that government stepped in. It's the point when you expect the state to step in.
Good. I think that's a very clear answer. Thank you very much. I think we could have some questions from the audience. We've got a few minutes left. Okay, I'll take the top one. Will you consider the use of negative rates in the UK? And if so, how soon could this be introduced?
Well, we've said, Ben Broadbent, my colleague, said this a few days ago, that I think it's always wise, and particularly in this circumstances, not to rule anything out forever. And we certainly don't do that. And I think, a lot of other central banks are in the same place. It is not something that we are currently, planning for or contemplating. And you pose an important question there, that it would not just be a matter of the Monetary Policy Committee sitting down in a room and saying, let's do it. There is quite a lot of structural issues that you would have to do around it. And that would take some period of time. My own view also is that it would require, if we were to consider it, quite an extensive communications exercise, because I don't think it is just a sort of a linear move in interest rate, a further sort of, in a sense, linear move in interest rates. I think from a communications point of view, and therefore as a reaction and expectations point of view, it is a very big step.
Do you see it as stimulative, or do you see there's a reversal rate, as a rate at which it actually constrains the economy?
Well, I think one of the things that all the analysis the bank has done over recent years is that, as you approach the zero bound, the degree of what I might call sort of conventional stimulus does reduce. Now, that's, by the way, why in Mark Carney's last MPC, the MPC introduced another term funding scheme, because that's a way of reinforcing the official rate by the bank providing long-term liquidity at the official rates. I think you would get further issues as you go negative. I think that sort of barrier or restriction would get worse, because you would obviously get big issues for some parts of the banking system about how it was affecting their net interest margins, and so you would expect that to then feed back into the transmission mechanism.
Okay, we'll just have time for one more question from the audience, please. Is unprecedented stimulus going to bring on high inflation, or is traditional economic theory dead?
I don't think it is going to bring on high inflation, which isn't, of course, let me be very clear, of course, it isn't that we don't watch out for the inflationary impact. But of course, one of the big things about the world we're in, which was true before we got into the situation with COVID, was that we're now in a world of much lower, what the economists would call R-star, the equilibrium rate has come down. That's for structural reasons largely. So we're operating in a very different world in that sense. And as we were saying earlier, I don't think that we see the evidence that there is going to be a rapid rise in inflation in the current context. I just don't think the evidence is there. Now, that's not to say that we are in any sense relaxed about that. We're doing all the work that we would always do to watch for that, but I don't see that as a major risk at the moment.
Okay, well, I think just very quickly before we wrap up, where would you like to be in a year's time? Very quickly, what would you like?
Well, I mean, I'm sure like where we'd all like to be. We'd all like to be beyond the COVID threat. I'm a very strong supporter of the work the government is doing, all governments are doing to implement systems to find a vaccine, to find treatments, to do test, track, trace. I mean, that's the thing that we all want to see, not just as citizens, but because that will be the biggest benefit to the economy. I mean, that's going to create the most degree of confidence. So that's, my hope, wish is that we can get to that point.
Andrew Bailey, Governor of the Bank of England, thank you very much.